In my last video, I introduced the concept of FIRE and explained how you can calculate your FI number. Today, I'll go over savings and withdrawal strategies for Shell employees that want to reach financial independence and retire early. Let's start with the end in mind. In the previous example, you wanted to be able to withdraw $96,000 a year from your portfolio and not get hammered with taxes and penalties. Today, we'll go over the different tax treatments for each bucket of money. We're going to assume that these are early withdrawals, meaning you are not currently 59 and a half, and we're also going to assume that you retired before the age of 55. Let's start with your pre-tax 401k. Within your pre-tax 401k, all withdrawals are subject to ordinary income tax of 10 to 37%. Additionally, you'll get hit with a 10% early withdrawal penalty. This is not the place you want to start withdrawing money from. Next, let's talk about your Roth IRA. Withdrawals of earnings out of your Roth IRA will also be hit with ordinary income and an early withdrawal penalty. However, you can take your contributions and your conversions out early as long as your conversions are greater than 5 years ago. By doing this, you will not pay a penalty or income taxes. This is a great place to be able to get some money, but make sure you don't deplete this bucket too quickly. Your Roth 401k has a lot of similarities to your Roth IRA, but there are some differences. One key difference is that you can't withdraw only the contributions and conversions from your Roth 401k. When you pull money out of your Roth 401k, the IRS looks at the entire balance and then calculates a pro rata amount. In that case, you will be taxed the ordinary income rates and pay the 10% penalty on early withdrawals. So pulling money out early from your Roth 401k is not something you want to do. However, one option to fill your Roth IRA bucket is to do direct rollovers from your Roth 401k to your Roth IRA, giving you more flexibility. Another option to fill your Roth IRA bucket is to do rollovers and conversions from your pre-tax 401k after you've left Shell. One important note about this is that is a taxable event. So make sure you're doing it in small chunks and you're reviewing with your tax professional how it impacts your entire tax picture. Next, let's talk about your taxable brokerage account. The taxable brokerage account has two types of tax treatments. There are short-term capital gains and long-term capital gains. Short-term capital gains are for investments that have been held 1 year or less. They are taxed at ordinary income rates. Again, not a place that you want to pull money from. Once you've held an investment for greater than 1 year, it qualifies for long-term capital gains. With long-term capital gains, it's a much more favorable tax bracket, ranging from 0 to 23.8%. This is definitely an area that you want to consider withdrawing money from. The 0% tax bracket is something that is not commonly talked about. If you're in early retirement and your income has drastically gone down, you can get money out of your taxable brokerage account, pay zero taxes as long as your taxable income stays below $80,000 and you file married filing jointly. Last, let's talk about cash in the bank. When you pull cash out of the bank, there's no taxes. So this is a great place to get your money from, especially if you got a severance when leaving Shell. One note about cash in the bank, the downside is, of course, it's not really growing much. So make sure you don't have too much in there relative to the rest of your investments. Okay, now that we've talked about how to withdraw money, let's talk about some strategies that you can do now. First and foremost, make sure you hit your target. Calculate your FI number as talked about in the previous video, and then track your progress towards it each year. Second, make sure you fill up your Roth IRA bucket. You want to do this often and early because of this 5-year conversion limit. Two ways to do that are your backdoor Roth IRAs and, for Shell employees, doing a mega backdoor Roth IRA utilizing the Shell 401k. And lastly, make sure you don't forget to fill up your taxable bucket. You definitely want to prioritize IRAs and 401ks first because of their tax advantages. However, your taxable brokerage account has two other advantages. One, it provides flexibility, which is very valuable. And two, there's no contribution limit on it. You can put as much as you want in any given year. Now, one last part to talk about regarding financial independence and early retirement. Too often people come to me and say, I really want to leave my current job. I encourage you not to run from your current job. Make sure you are running to something. What gives you passion? What gives you joy? If you want to reach financial independence, shoot me a note and let me help guide you there.